Hey there, I'm estate planning attorney Paul Rabelais, and in this video I am going to go back and revisit this big deal about both the loss of the carryover basis when someone donates appreciated assets to another and the loss of the step-up in basis when someone leaves appreciated property to another. So there's serious legislation introduced in Congress. We're going to go through all of that here, but let me first go over the current rules. The current rules, I'm going to go over two rules. The capital gains tax basis rule for gifts during lifetime and the capital gains tax basis rule for property left at death. All right, so under both examples, let's say Dad acquired stock, property, you name it. Doesn't really matter what the asset is, but they acquired it, many years ago for $10,000, and now that property, that stock, whatever the asset is worth $200,000. Well, under the current rule, if Dad were to give away or gift that asset to, let's say, his son, then Dad made a $200,000 gift, no taxes due, but Dad did use up some of his $11.7 million estate tax exclusion amount, but that he has to report on the gift tax return, but no taxes due. But by Dad giving to son a piece of property that is worth $200,000, but Dad paid $10,000 for it, there's $190,000 of untaxed gain. Under our current rules, if Dad gives that asset to his son, nobody owes any tax, but son gets Dad's carryover capital gains tax basis of $10,000. What that means is when son sells the real estate, he may not sell it when he gets it. He may not sell it for years after he gets it, but whenever he does sell it, he will pay capital gains tax on everything above $10,000, which was Dad's basis, because when Dad made a gift during Dad's lifetime to son, son got the carryover basis from Dad's basis. All right, so that's the gifting carryover basis current rule. The other rule currently is the inheritance step-up in basis. So let's say in our previous example, Dad acquired an asset, the basis is $10,000, and Dad doesn't give that asset to his son. It's worth $200,000. Instead, Dad dies and leaves that son the $200,000 asset. So again, it's in Dad's estate, and Dad's $11.7 million may shield that from estate tax. But because Dad left that to son as an inheritance, better tax rule here, son enjoys what's called the step up in basis. So all that $190,000 of untaxed appreciation just goes untaxed because Dad left it as an inheritance, and Dad and son's basis, now that he inherited it, Dad died, it was worth $200,000. That's going to be son's basis in the property. So whenever son sells it, maybe immediately, maybe many years later, maybe never, but if he sells it, he'll pay capital gains tax on everything that he received in excess of the $200,000 value on the date that Dad died. That's the step-up in basis rule for inheriting assets. Okay, so you got a gift tax carryover basis and inheritance step-up in basis. Now let's take a look at what the proposal is. And there's a Senate proposal and there's a House proposal. They're very, very similar. So let's look at the Senate proposal, which says that any property which is transferred by gift, in trust, or upon death shall be treated as sold for its fair market value to the transferee on the date of such gift, death, or transfer. House language, very similar. It uses the words gift or death, doesn't use the words in trust. But the House proposed language is any property which is transferred by gift or at death, either one, any property which is transferred by gift or at death shall be treated as sold for its fair market value on the date of such gift or death. Okay, so that's interesting. So go back to our example where Dad had a basis of $10,000 and now the property is worth $200,000, and Dad just gives that piece of property to his son. Under these proposed rules in both the House and the Senate, even though son received a piece of property worth $200,000 and dad gave away a piece of property worth $200,000, that's treated as a sale from dad to son for $200,000, the fair market value on the date of the gift. So now dad has to pay tax on all of that gain. He gave away the asset. He didn't get any bump in cash because he gave away the asset, but he still owes the tax on the gain. So not only will there be, people thought the carryover basis on a rule on gifts was bad. That rule is incredible for people compared to the new rule, which says that when someone makes a gift of an appreciated asset, it's treated as a sale for fair market value. So real tough one there. Similarly tough is how they're going to treat property inherited. So go to our example. Dad has property, $10,000. It's now worth $200,000. Dad dies, leaves that piece of property to his son. Well, then that transfer to the son is treated as if the property was sold for its fair market value on the date of the death. So as of the date of death, you look at the value and it's treated as a sale, and so there's all this tax due. So that is just a big deal. It's kind of the first time I've seen where there's this big taxable event where significant tax is due, but the taxable event didn't create any cash to pay the tax. So big deal there. There are some exceptions to these rules. Give you a few exceptions to the rules, the proposed rules. Transfers between spouses are exempt. Transfers to revocable living trusts are exempt. Outright gifts and bequests to charity are exempt, so you could still give away your stuff to charity, and then the charity can sell the asset and not have to pay the capital gains tax. Also exempt from this proposed rule is tangible personal property not used in a trade or business or for the production of income. So if you give your daughter your fine china, I think you're going to be okay. And there's a $100,000 gain exclusion for gifts during life. Dad gives away an asset during his lifetime with $300,000 of gain. There will only be $200,000 of gain recognized due to the $100,000 exclusion. There is a $1 million gain exclusion for gifts at death. And by the way, for spouses, it's portable between spouses. So if the first spouse to die doesn't use it, the surviving spouse will get to use the first spouse to die's unused portion of the $1 million gain exclusion for gifts at death. So bottom line is under the proposed legislation that's in both the House of Representatives and the Senate and Congress, there will no longer be a carryover basis for assets transferred during lifetime, and there will no longer be a step up in basis for assets transferred as a result of death. Both of those assets transferred will be deemed a sale for fair market value, and then the appropriate capital gains tax will apply, which, by the way, another issue, maybe another video, the proposed capital gains tax rate is going from 20 to 25%. So a lot of stuff there. If it passes, it is significant, and it will change the game for what parents and grandparents will need to do, will want to do to try to just keep what they have in their family and try, if they've worked very hard during their lifetime, like so many people have, and they just want to pass along and try to make things a little easier for their descendants. There's going to be just a lot of the previous strategies are going to be thrown out the window, and a lot of new thought will be necessary, assuming this loss of carryover basis and loss of step up in basis passes. I'll keep you posted. Make sure you subscribe to the channel. Make sure you click the notification bell. That way, any new developments, I'll keep you posted. Make sure you like. Feel free to comment down below. We'll see you next time.